A stock rises by 50%. What actually made you money? Did the business become more valuable? Did investors simply agree to pay a higher valuation, or did luck happen to be on your side? If you cannot answer that question, a rising price can make luck look like skill. And when the price falls, you will not know whether to hold, buy more, or admit that the original thesis was wrong. So before asking, which stock should I buy? Ask a more important question. What has to go right for this investment to earn a return? In this video, I will break stock returns into 3 sources and explain which one I want to rely on most. This is Ginkgo leaf. I am an individual investor using my own capital to study businesses. This channel is where I document how I understand a company, estimate its value, and revise my conclusions when new evidence appears. That process begins with a basic question. What does a share of stock actually represent? When you open a brokerage app, the first things you see are a ticker symbol, a price, and a moving chart. Because the price changes every second, it is easy to focus entirely on the next quote. But behind every share is a real operating business. Take Costco. When you buy a share of Costco, you own a tiny piece of its warehouses, membership system, merchandise sales, cash flows, liabilities, and future profits. In fiscal 2025, Costco had more than 81 million paid members. Its renewal rate in the United States and Canada was above 92%. Membership fees generated more than $5 billion. Those numbers describe a real commercial system operating behind the ticker symbol. Do members keep renewing? Do customers continue shopping? Can Costco maintain low prices while turning inventory efficiently? Those questions will influence the long-term value of the business. A 3% move in the stock price today does not immediately change any of those facts. The market offers a new quote every moment. The business continues operating every day. Price sets the terms of the trade. Business performance determines the long-term result. So how does business performance become a return for shareholders? The first source is the one I care about most. A business creates value by solving a problem for its customers and earning revenue and profit in return. If it can reinvest part of that profit at high rates of return, it may generate much more cash in the future. But growth in the size of a company does not automatically benefit its existing shareholders. A company can grow by issuing large amounts of stock, overpaying for acquisitions, or investing huge amounts of capital for weak returns. The company becomes larger, but the economic value represented by each share may barely improve. Think of a pizza. 1 pizza becomes 2, total production has doubled. But if the number of slices rises from 8 to 20, the amount of pizza represented by each slice may have fallen. Microsoft provides a useful positive example. In fiscal 2015, Microsoft generated about $94 billion in revenue. By fiscal 2025, revenue had grown to roughly $282 billion. That is close to 3 times the original amount. Over the same period, Microsoft's diluted share count declined from about 8.25 billion shares to roughly 7.47 billion. Using operating cash flow minus capital expenditures as a rough estimate, free cash flow per diluted share increased from about $2.80 to roughly $9.60. The business became much larger, and a meaningful part of that progress reached each individual share. A complete analysis would still need to examine Microsoft's capital expenditures, stock-based compensation, acquisitions, and the investment required to maintain its competitive position. But the central lesson is simple. Shareholders ultimately own the per-share result. Revenue growth and total profit growth are intermediate steps. What matters is how much earning power and cash flow each diluted share represents. If a business can generate more cash per share 5 years from now, shareholders may earn a satisfactory return even if the market never gives the stock a higher valuation. But creating cash is only the first part of the process. The next question is what management does with it. Once a company earns cash, management has several choices. It can reinvest in the existing business. It can acquire another company. It can repay debt, it can pay a dividend, or it can repurchase shares. Dividends are relatively direct. The company transfers cash to shareholders, and shareholders decide what to do with it. Share repurchases require more investigation. Snowflake spent about $1.9 billion repurchasing shares during the fiscal year that ended in January 2025. Viewed only through the size of the buyback, this might look like a substantial return of capital. But Snowflake's year-end share count was almost unchanged. It moved from roughly 334 million shares to just under 334 million shares. During the same year, the company recorded about $1.48 billion of stock-based compensation. A large portion of the repurchases was therefore absorbed by employee equity issuance and other dilution. The net reduction in shares available to existing shareholders was minimal. This does not prove that every repurchase was a mistake. It shows why the headline number is not enough. When I evaluate a buyback, I ask 3 questions. At what price did the company repurchase the shares? Was the buyback funded by sustainable cash generation or by additional debt? And after employee equity awards and all other sources of dilution, how much did the fully diluted share count actually decline? A buyback announcement tells you how much the company spent. The diluted share count tells you more about what shareholders actually received. There is also no universal answer to the choice between reinvestment, dividends, and repurchases. When a company still has many opportunities to reinvest at high returns, retaining cash may create more value. When attractive reinvestment opportunities have disappeared, returning cash to shareholders may be the more rational choice. Every capital allocation decision should face the same test. Did it increase long-term value per share? Even when the business is excellent and management allocates capital intelligently, an investor can still earn a poor return. That brings us to the third variable, the price paid. Cisco during the dot-com bubble is a classic example. From fiscal 1999 to fiscal 2000, Cisco's revenue increased from about $12.2 billion to $18.9 billion. That was growth of more than 55% in a single year. Cisco was one of the most important suppliers of internet infrastructure, and its gross margin was above 64%. The internet continued to expand. Cisco remained profitable. By fiscal 2025, annual revenue had reached roughly $56.7 billion. The long-term technology trend was real. The company continued producing substantial revenue and profit. But at the market peak in 2000, Cisco traded at more than 200 times earnings. Its share price later fell by close to 90%. Excluding dividends, it took roughly a quarter of a century for the stock to return to its old high. The industry thesis could be broadly correct. The company could remain important and profitable. The investment result could still be extremely poor. The starting price had already assumed too much success. That is why valuation matters. When a stock trades below a reasonable estimate of business value, an investor may earn returns from 2 places. The first is continued value creation by the business. The second is a narrowing of the gap between price and value. A lower purchase price can also provide room for analytical error. No forecast of future revenue, margins, competition, or capital requirements will be perfectly accurate. But a falling share price does not automatically make a stock cheap. A competitive advantage may be weakening. Profits may no longer be sustainable. The balance sheet may be deteriorating. A stock can fall from $100 to $50 and still be expensive if the underlying value has fallen from $80 to $30. Understanding the business has to come before judging the price. Growth in per-share value is the engine. Capital allocation determines how value reaches shareholders. The purchase price determines whether the expected return justifies the risk. This leads to another question. With thousands of headlines and constant market movement, where should I focus my attention? I do not need an opinion about every daily stock price movement, every news headline, or every change in the macroeconomic narrative. I need to focus on a small number of variables that can be examined over time. Meta's experience in 2022 illustrates this approach. That year, Meta's revenue declined by about 1%. Its operating margin fell from 40% to 25%. Its share price also suffered a major decline. But once the operating data is separated, several very different questions appear. Daily active users across Meta's family of apps still grew. Ad impressions increased, while the average price per ad declined. Reality Labs reduced operating profit by roughly $13.7 billion. Capital expenditures reached about $32 billion, and Meta spent close to $28 billion repurchasing its own shares. Each variable tells a different part of the story. User growth helps reveal whether the platform's underlying usage remains intact. Ad volume and pricing show how effectively the company is monetizing that usage. Reality Labs' losses and capital expenditures reveal where management is directing shareholder capital. The size and price of the repurchases affect how much value ultimately reaches each share. A stock chart cannot tell you which part of the business has changed. That is why I will focus on questions that can be tested. Why are customers willing to pay? How much profit can the company retain? How much of that profit becomes cash? How much capital is required to support growth? Are shareholders being diluted? How is management allocating the cash? And what future is already embedded in today's price? My research advantage will not come from predicting tomorrow's market movement, reacting faster to headlines, or repeating stories that cannot be verified. I will also avoid leverage that can take away the ability to wait. Business value does not emerge on a fixed schedule, and the market has no deadline for becoming rational. A long-term judgment may ultimately be correct, yet the investor can still be forced out early by margin calls, debt maturities, or personal cash flow pressure. A durable investment process should preserve the ability to wait, review the evidence, and correct mistakes. These principles ultimately have to be applied to real companies. When I study a business on this channel, I will repeatedly return to 7 questions. What does the company actually sell and who pays for it? Why are customers willing to pay? Why is it difficult for competitors to take away the company's profits? How much reported profit becomes owner earnings on a per-share basis? How does management allocate shareholder capital? What future performance is already required by the current price? And what evidence would show that the original thesis is wrong? Consider the NVIDIA research currently in progress. I will not stop at asking how long demand for artificial intelligence can continue growing. I will also ask, what economic return do customers receive from buying NVIDIA's GPUs? How much switching friction does the CUDA ecosystem create? How could custom chips developed by major cloud companies affect NVIDIA's pricing power? How long can data center capital spending remain at today's level? How many years of high growth and exceptional margins are already embedded in the stock price? And which operating data would indicate that the thesis is weakening? These questions are slower and more difficult than making a simple price prediction, but they can be researched, monitored, and revised when the evidence changes. I will try to separate verified facts from interpretation and future assumptions. I will present the evidence supporting a conclusion and actively search for the strongest opposing case. When the business changes, I will preserve the original thesis, identify what changed, explain where the error occurred, and show why the conclusion has been revised. No investor can be right all the time. A more useful goal is to make errors detectable, limit the damage they can cause, and turn each mistake into a rule that improves the next analysis. These are the returns I am preparing to earn in the stock market. The primary source is long-term growth in value per share. Dividends and intelligent share repurchases transfer part of the value created by the business to shareholders. And when price is meaningfully below value, the investor may receive a higher expected return while gaining some protection from analytical error. I will study the business carefully. I will take the price seriously. I will accept uncertainty. And I will write down in advance what evidence could prove me wrong. Ginkgo Leaf will cover business analysis, valuation methods, and real companies. The NVIDIA deep dive is already in progress and will be published when the research is complete. If you want to understand how companies create long-term value and how much future success today's stock price already requires, subscribe to Ginkgo Leaf. Here, I will try to make every important judgment clear, and I will put the weakest parts of the analysis on the table.